Welcome back to our special series, Hello 2017. We've been speaking to a series of financial experts on where they see India and the world in 2017. We've been speaking with Mr. Puri, the Managing Director and CEO of UTI Mutual Fund. How do you see FY18 for the banks? Will it be the end of the tunnel at all?
I think there are two things which could be helpful to the banks if we get this right. One is that this is a push for further financial inclusion and participation, and the banks are the first major beneficiary of that. I hope ultimately capital markets too will be, but the first beneficiary is the banking system. Again, if you ignore the temporary hiccups around extraction of liquidity through CRR and so on, which happened, in the next 3 to 6 months, we will see and get a sense of the stabilization of CASA and the banks. And I think that is a good thing. You will also see in possibly 6 to 12 months, maybe not in 0 to 6, some room for the treasury gains that some people have written about, which would at least be a financial optical assistance for the banks and their balance sheets. It will help strengthen that. And to some extent, again, mathematically, because their denominator is sort of growing, the numerator on their NPA improves, which gives the government a bit of breathing room. But I would hope that the government will view in its next budget an opportunity to complete the recapitalization of banks. I think we have been a little hesitant in following through. I think they deserve now a proper vote of confidence, and they need a vote of confidence. The public sector banks need that vote of confidence if they are to actually survive. So I would expect that to actually happen this year. The second is, again, there appears to be some confusion around where we are headed with asset restructuring.
Exactly.
We had a tremendous push in 2015-16. Again, we thought we were in a paradigm shift. We've had the Insolvency Act, and that seems to have got defocused a little bit. Again, I would hope for 2017, that we will come back to this.
How do you see the banking sector evolve?
Another element which has been defocused for now was the process of the evolutionary privatization of the public sector banks. We had a process that was started, the Gyan Sangams and so on, which was evolving ways of thinking about gradual improvements in governance, relative levels of independence, using consolidation and restructuring to essentially separate perhaps the national champions from the rest that could be privatized in effect through both governance and shareholding changes. And I think that role, the Bank Board Bureau was constituted. And we must be careful not to abandon all these and as again, at least from the public eye, some of these look a little orphaned right now. I hope that's not the case, because those were very good initiatives. And therein lies the answer to the question. What are you going to do with these? It's not just about pumping in capital, more good money after bad. It's about using this as an opportunity to catalyze the creation of new healthy institutions through these changes. So again, and here I remain cautiously optimistic. If we are going to push for economic transformation, if that is our newfound energy and conviction that we are displaying, and 2017 is the year in which we will have a government committed to revolutionary transformation of our economy, then I really hope that this issue will once again be taken up vigorously.
One more question on the banks before I get to the financial markets. Once before, many years ago, when you were, in the heart of banking, the RBI, and in fact the government had used recap bonds to recapitalize the banks. Would you still advise, if you're otherwise financially constrained, somehow recapitalize with these recapitalization bonds?
They are a temporary solution. They don't offer as much long-term confidence to the markets. So if you're dealing with a crisis, recap bonds are excellent, because they're the finger in the dike. If you're dealing with a signal that says we are serious about the reform of the efficiency of our banking system and its ability to allocate capital properly for the future, then recap bonds are not going to be the end of it. Then you do need to go back to the agenda that was laid out through the creation of Bank Board Bureau, the Bank Holding Committee. those are very good things.
Well, let me finally come to a sector that you are now presiding, the mutual fund sector. How do you see that evolving? Do you see more sophistication in 2017? Do you see more consolidation process?
Well, I think, again, I hope that one of the effects of demonetization will be to deepen financial participation in the banking system and therefore eventually the savings markets and therefore ultimately the capital markets, both debt and equity, because this money will seek out higher yield. It's up to us to position our products appropriately as a substitute for either fixed deposits or savings accounts, and to start capturing that. And we're giving a lot of thought to that. So we do believe that this will be a material expansion of the base of customers who come into the mutual fund sector. And it's up to us to create products that are simple enough to
You can show the way, because UTI Mutual Fund really is the pioneer of mutual fund itself, and still I think has the widest distribution.
Yes, and we are very committed to that. So we are very committed to enrolling new distributors as well as opening up new locations, as well as using digital technology very effectively through both mobile and the website that we revamped. So all of this is going to happen. It's up to us. It's an opportunity that is there for us to take. And things like eKYC, and there's certain operational issues which are getting resolved, which could make a very big difference if we get that right too. So we're quite positive about that. So this is good news for the capital markets. Not all of this money will come into equities immediately. The industry includes debt products. In fact, the best performing products in 2016 have been the debt products. Equities have been more or less flat. For most people, when they look at their portfolio at the end of this month, will be a little disappointed perhaps that this year has not been the year when equities have performed well. But those who had a balanced portfolio look at debt will see returns of 13, 14% in some cases, and perhaps feel a little more cheered up. And to us, we are somewhat agnostic. We are happy that flows come into capital markets because buying bonds fuels economic growth as much as buying equities. And those are judgments based on economic cycles and risk appetite, and that we shouldn't be concerned. I do think, though, next year we'll again start to see equity returns pick up. And as you know, equity returns over a 20-year period have been 13% or so.
We've really made money in bonds. What will 2017 be?
Well, I think 2017 may not have as much opportunity, as I said, certainly in the first half, for rate cuts. So I think accrual products will continue to do well. I do anticipate that you'll see earnings recovery very strongly from the middle of the year onwards as the effects of demonetization wear off and the demand stimulus we talked about earlier kick in. So I do think you'll see the market start to price that in. And this could happen as early as March or April. And of course, if we have a good budget, you know, it may happen even sooner because we are still a fairly emotional market in that sense. So I do anticipate, once again, some reallocation towards equities next year domestically.
On that cheerful note for the markets, Mr. Puri, thank you very much for joining us on our series, Hello 2017.
Thank you.